Hey everyone, we had some massive news for Supermicro stock this morning that sent the stock price crashing as much as 13% before rebounding back a little bit higher. So in this video, I'm going to review what that latest development was that sent the stock price crashing, and I'm going to dig into deeper into why this happens when a stock does this and why the stock price crashes and the deeper layers of understanding around this financial maneuver. So let's jump into the details and let's understand what this could mean for Supermicro stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so the latest news that sent Supermicro stock price crashing was an announcement that the company was going to sell 200 million shares of their common stock. Now, this comes after they already had 56 million shares of their common stock outstanding. So this 2 million shares of common stock is going to dilute shareholders by roughly 4%. I want you to understand why shareholder dilution is important. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Okay, so now that you've got a grasp of that financial concept, you can understand why Supermicro stock price was down 8.83% as of this recording. You can see it was down as much as 13% before rebounding back up higher. Shareholder dilution reduces the profitability of the earnings per share. Still, there's a little bit of a mismatch here, and I wanted to dig into deeper of that detail. Supermicro diluted shareholders by roughly 4%, less than 4%, but the stock price was down by as much as 13% on this news. So theoretically, the stock price should decrease by roughly the amount of the shareholder dilution, but Supermicro stock was down nearly 3-4 times as much. So what gives with that difference? Here's why. So when a company sells shares of their stock, it's an indication that management believes their shares are overvalued. It's not a straight out statement saying, hey, we think our shares are overvalued, but it has that hidden meaning behind it. When a company sells their shares to the public, it's kind of indicating that they feel it's overvalued, because nobody knows more about Supermicro's prospects than the CEO, the CFO of the company. And if they're deciding to sell shares to raise cash, then they've communicated with each other and they've agreed that it's a prudent thing to do, especially when a company is not in a desperate situation. Supermicro is not in a desperate situation. Its company is growing rapidly. It's benefiting on the back of the rising effectiveness of artificial intelligence. So they're not in a desperate situation. This was more of an opportunistic sale. This is more of the, hey, let's capitalize on our share price that's up significantly over the last year. Supermicro stock price, even after today's decline, is up over 845%. So this is more of management saying, hey, let's opportunistically benefit from this higher share price. That's why the stock price, in my opinion, fell by multiples more than the dilution effect is because the hidden meaning behind a share sale from management, signaling they could feel the shares are overvalued. Now, there is an additional option for the underwriter to buy 300,000 more shares, so it could dilute shareholders even more, but not that much more, roughly 10% more than the 2 million. And then the reason they state that they're going to raise this money is the principal purpose of the offering is to obtain additional capital to support their operations. And there is truth to that, because if you look at its latest quarterly revenue, the cash from operations, they were negative 595 million. And the company prior to this announcement had only 725 million in cash. So they couldn't sustain this level of cash flow from operations, a negative, with only 725 million in cash. They needed to raise more capital or change the way they do their business. Now, if you remember in my previous videos, I had said that management is taking a more aggressive growth strategy, offering good prices to gain traction, and management said they're conducting the land and expand strategy. They're offering good introductory terms to the businesses that they're selling to, with the hopes that they land initial deals and then broaden out and secure more deals with that company. That strategy also has the company not as profitable as it could be and generating not as strongly of cash flow as it could be. Nevertheless, always when a company is growing as rapidly as Supermicrocomputer is, and that rate of growth is accelerating like Supermicrocomputer is, it has a negative effect on your cash flow from operations, because you're spending all this money to build your inventory and then sell your inventory. And in the meantime, you're not getting paid back just yet. Most of these sales are to other businesses. Supermicrocomputer makes these sales on accounts receivable, and those companies get 30 days, 60 days, or 90 days to pay back. And given management's aggressive growth strategy, I wouldn't be surprised if they were offering favorable payback terms to their businesses that they were selling their products. And so that's been hurting their cash flow from operations, negative 595 million, as you could see in the latest quarter, and weighing down their cash and equivalence balance. So this was a necessary move. They needed to raise capital. They didn't necessarily need to do it by selling stock. They could have borrowed money. They also could have changed their operations strategy. Given the strong demand for their products, they could have secured better terms from buyers. They could have lowered incentives and made sure that each sale was coming more profitably. And maybe it would have slowed down their growth rate, but they would have grown more sustainably and not generate such negative cash flow from operations. So these are the reasons why Supermicrocomputer stock price today is down so much, because of that stock sale and the implications of what it says about what management thinks about its stock price following the significant rise. Of course, I made a video 12 days ago asking if it was finally time to take profits in Supermicrocomputer stock. And in this video, I said, yes, it was a good time to take profits in Supermicrocomputer stock. And since this video was out, the stock price is down. Let's go back 1 month, and you can see that the stock price is down off its highs. It's still up significantly for the year, but it's down off its highs following a significant rise. Of course, I recommended Supermicrocomputer stock as a buy in the first 2 weeks of January, and then I suggested those that followed that recommendation, it was a good time to take profits and sell because the valuation was getting stretched. It was trading at a forward price to earnings ratio way above its historical average. I could go back 4 to 3 years. It's way above where its historical average was. So I suggested it was a good time to take profits in Supermicrocomputer stock. Nevertheless, this news specifically is not terrible news for Supermicrocomputer stock investors. It just means there's going to be more shares outstanding and your earnings per share are going to be lower, but the company's going to use this cash that it raises to fund its operations, and hopefully it turns into more profits down the road because it's going to fund its growth. It can continue this growth strategy longer term because now it's going to have more cash to sustain that growth, whereas previously it may have had to change that strategy given that it was working down its cash balance. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.